Hello there, MSL here, and welcome to this IFRS summary video on IFRS 13 fair value measurement, which applies to IFRSs that require or permit fair value measurement or disclosures and gives us a single IFRS framework when it comes to measuring fair value. So, quick recap of where we started from and where we are today. As a standard, it dates back to September 2005 all the way through to May 2011 when IFRS 13 was finally issued. Now, as a standard, IFRS 13 fair value measurement was originally issued in May 2011 and it applies to annual reporting periods beginning on or after 1st January 2013. With respect to this standard, what is the objective of IFRS 13? Why was it issued in the first place? IFRS 13 defines fair value clearly, and it sets out in a single IFRS a framework for measuring fair value, and it also gives us required disclosures about fair value measurement. Take note also when it comes to the scope of IFRS 13 that IFRS 13 fair value measurement applies when another IFRS requires or permits fair value measurement or disclosures about fair value measurement. And take note here, it will apply to measurements and disclosures around fair value less cost to sell and other fair value measurements that are based on fair value or disclosures about fair value measurement. With respect to this statement I just made, there are some things that are outside the scope of IFRS 13 fair value measurement. An example would be share-based payments within the scope of IFRS 2, share-based payments. The next would be leasing transactions within the scope of IFRS 16 leases. And then any measurements that have similarities to fair value, but that are not fair value in and of themselves. An example would be net realizable value as used in IAS 2 inventories, or the expression value in use as used in IAS 36 impairment of assets. It's important to mention that additional exemptions apply to specific disclosures as required by IFRS 13. Now let's look at the main component of the standard, which is known as a fair value hierarchy. Let's look at an overview of the fair value hierarchy. Now, IFRS 13 seeks to increase consistency and comparability in fair value measurement and related disclosures through something called a fair value hierarchy. Now, this fair value hierarchy categorizes the inputs used in valuation techniques into three main levels. The hierarchy gives the highest priority to unadjusted quoted prices in active markets for identical assets or liabilities, and it gives the lowest priority to unobservable inputs. The biggest takeaway point for you from this is that if the inputs used to measure fair value are categorized into different levels of the fair value hierarchy, the fair value measurement is categorized in its entirety in the level of the lowest level input that is significant to the entire measurement, obviously based on the application of judgment. So if you have multiple inputs falling within different levels of the hierarchy, which I'll talk about shortly, then you are required to use the lowest level that is applicable. Now that we know that there is some fair value hierarchy, let's begin to look at the detailed levels into some specific details. The first is what we call level 1 inputs. What are level 1 inputs? Level 1 inputs are quoted prices in active markets for identical assets or liabilities that the entity can access at the measurement date. I have just mentioned active market. How does IFRS 13 define an active market? IFRS 13 fair value measurement defines an active market as a market in which transactions for the asset or liability take place with sufficient frequency and volume to provide pricing information on an ongoing basis. So any market in which transactions for that particular asset or liability occur or take place with a lot of frequency and volume to the extent that it can give us enough pricing information on an ongoing or a continuing basis is deemed to be an active market. So to recap, we've said level 1 inputs are quoted prices in active markets for identical assets or liabilities that the entity can access at the measurement date. It's important to also note that a quoted market price in an active market provides the most reliable evidence of fair value and is used without adjustments to measure fair value whenever available with limited exceptions. So take note, level 1 is given the highest priority because it's deemed to be the most representative of fair value. Let's also mention that if an entity holds a position in a single asset or liability, and that asset or liability is traded in an active market, then the fair value of the asset or liability is measured within level 1 as the product of the quoted price for the individual asset or liability and the quantity held by the entity, even if the market's normal daily trading volume is not sufficient to absorb the quantity held, and placing orders to sell the position in a single transaction might affect the quoted price. So essentially, all we are saying here is that for level 1 inputs, take note, it reflects or it relates to quoted prices in active markets for identical assets or liabilities that the entity can access at the measurement date. And remember, level 1 inputs are your most reliable and they are the most representative of what fair value really could be. And to recap, how does IFRS 13 define fair value? The standard defines fair value as the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Now that we know this, let's move to level 2 inputs. Level 2 inputs are inputs other than quoted prices included within level 1 that are observable for the asset or liability either directly or indirectly. So what would this mean for you? It means if you want to define level 2 inputs, then level 2 inputs are all inputs other than quoted market prices within level 1, which I just spoke about, that are observable for the asset or liability either directly or indirectly. To summarize, level 2 inputs are observable inputs that are not quoted market prices in level 1. But let's give some examples of level 2 inputs. This list is not exhaustive, but to give you a clear indication of what will fall within level 2. So level 2 inputs will include quoted prices for similar assets or liabilities in active market. And remember, we just defined an active market to mean a market in which transactions for the asset or liability take place with sufficient frequency and volume to provide pricing information on an ongoing basis. So now we know that one indication or one sign or one example of level 2 inputs will be quoted prices for similar assets or liabilities in active markets. The next indication of a level 2 input could be quoted prices for identical or similar assets or liabilities in markets that are not active. So here you find a market that is not active and you look for quoted prices for identical or similar assets or liabilities, and that could be your level 2 input for the fair value. The next could be inputs other than quoted prices that are observable for the asset or liability. Examples of this will include interest rate and yield curves that are observable at commonly quoted intervals. Another example could be implied volatilities, and another one could be credit spreads. Then finally, within level 2 could be inputs that are derived principally from or corroborated by observable market data by correlation or other means, which we can refer to as market corroborated inputs. So remember, level 2 inputs are inputs other than quoted market prices within level 1, which are observable for the asset or liability either directly or indirectly. And remember, level 1 is more preferred before you come down to level 2. Now that we know level 1 and we know level 2, let's look at level 3 inputs. Level 3 inputs are unobservable inputs for the asset or liability. And unobservable inputs are used to measure fair value to the extent that the relevant observable inputs are not available, thereby allowing for situations in which there is little, if any, market activity for the asset or liability at the measurement date. And take note, an entity develops unobservable input using the best information available in the circumstances, which might include the entity's own data, taking into account all information about market participant assumptions that is reasonably available. So what must you take away from here? Level 3 inputs are inputs that are unobservable for the asset or liability and is the lowest level possible. Here you are neither having any quoted prices nor any observable inputs, either directly or indirectly. So here it's based on a lot of judgment and a lot of estimations, and is the farthest you can go from estimating fair value. Now let's look at the overview of the fair value measurement approach within IFRS 13 fair value measurement. The objective of a fair value measurement approach is to estimate the price at which an orderly transaction to sell the asset or to transfer the liability would take place between market participants at the measurement date under current market conditions. IFRS 13 provides that a fair value measurement requires an entity to determine all of the following I'm going to talk about. The first is they need to determine the particular asset or liability that is the subject of the measurement, and this should be consistent with the unit of account. The next thing an entity will need to determine will be that for a non-financial asset, the entity will need to determine the valuation premise that is appropriate for the measurement, and this has to be consistent with something known as the highest and best use of the asset or liability. How does IFRS 13 define highest and best use? IFRS 13 defines highest and best use as the use of a non-financial asset by market participants that will maximize the value of the asset or the group of assets and liabilities, example, a business within which the asset would be used. So now that we know that the second thing for a fair value measurement approach to consider will be the highest and best use, the next thing to be considered will be the principal or the most advantageous market for the asset or liability. Now, these are two separate terms and the standard defines them differently. First, IFRS 13 defines a principal market as the market with the greatest volume and level of activity for the asset or liability. In simple terms, where can you find the particular asset or liability being traded or sold or exchanged in the greatest volume or level of activity? So if you have a particular market that deals a lot more in a particular good, then that particular market will be deemed to be the principal market. For example, if certain toys or certain cars or certain gadgets are sold a lot more in a particular country than another country, then the country where that particular good is sold a lot more will be deemed to be the principal market for that particular good. The standard defines the most advantageous markets to be the market that maximizes the amount that will be received to sell the asset or minimizes the amount that will be paid to transfer the liability after taking into account transaction cost and transport cost. So take note, the most advantageous market is where you get the highest possible price if you are selling an asset, or the market in which you pay the lowest possible price if it's the liability you are transferring. So quick difference between principal market and most advantageous market is that for the principal market, you are looking at the market in which the asset or liability is traded in the most, which has the highest trading frequency, highest trading volume. Most advantageous market is where can I get the best possible deal? Where can I secure the best possible price if it's an asset? Or where would I have to incur the lowest possible cost if it's a liability? So take note, principal market and most advantageous markets are not the same, but they are required to be considered in your determination or in the process of arriving at your fair value. The next will be that the entity will need to determine the valuation techniques appropriate for the measurement. And here they have to consider the availability of data with which to develop their inputs that will represent the assumptions that market participants would use when pricing the asset or liability, and the level of the fair value hierarchy within which inputs will be categorized. So an entity would need to determine all of these four factors I just spoke about when they are determining their fair value. IFRS 13 fair value measurement provides some further guidance on fair value measurement, which are really important to be aware of. IFRS 13 provides a guidance on the measurement of fair value, including the following. The first is that an entity takes into account the characteristics of the asset or liability being measured that a market participant would take into account when pricing the asset or liability at the measurement date. A typical example here will be the condition and the location of the asset and any restrictions on the sale and use of the asset. So if there are any particular characteristics that will be taken into account when pricing the asset, for example, if its current location is new or used, then obviously you need to factor that in when you are determining the fair value. The next is that fair value measurement assumes an orderly transaction between market participants at the measurement date and the current market conditions. The next that needs to be considered in the guidance is that fair value measurement assumes a transaction taking place in the principal market for the asset or liability which I just defined, or in the absence of a principal market, then you need to also consider the most advantageous market for the asset or liability. So clearly this measurement guidance is telling us that an entity will need to consider the principal market first. In the absence of a principal market, then you can rely on the most advantageous market. The next guidance in measurement is that a fair value measurement of a non-financial asset takes into account its highest and best use. And remember, I defined highest and best use to be the use of a non-financial asset by market participants that will maximize the value of the asset or the group of assets and liabilities within which the asset would be used. The next guidance we are given under IFRS 13 is that a fair value measurement of a financial or non-financial liability or an entity's own equity instrument assumes that it is transferred to a market participant at the measurement date without settlement, extinguishment, or cancellation at the measurement date. And then the next is that the fair value of a liability should reflect non-performance risk. And this is the risk that the entity will not fulfill any given obligation. And this will include an entity's own credit risk and assuming the same non-performance risk before and after the transfer of the liability. And finally, there's an optional exception that applies for certain financial assets and liabilities with offsetting positions in market risk or counterparty credit risks, provided certain conditions are met. IFRS 13 gives rules around additional disclosures that are required for some of these things. Let's look at valuation techniques provided for within IFRS 13 fair value measurement. The standard provides that an entity uses valuation techniques that are appropriate in the circumstances and for which sufficient data are available to measure fair value. At the same time, maximizing the use of relevant observable inputs and minimizing the use of unobservable inputs. And it's important to mention here that the objective of using a valuation technique is to estimate the price at which an orderly transaction to sell the asset or to transfer the liability will take place between market participants at the measurement date under current market conditions. Let me mention here that there are three widely used valuation techniques as provided for by IFRS 13 fair value measurement. There is the market approach, there is the cost approach, and then there is the income approach. The market approach uses prices and other relevant information generated by market transactions involving identical or comparable or similar assets, liabilities, or a group of assets and liabilities to arrive at fair value. The cost approach will reflect the amount that will be required currently to replace the service capacity of an asset. This is what you can call in accounting terms as the current replacement cost. The income approach converts future amounts, which could be cash flows or income and expenses, to a single current discounted amount, which reflects current market expectations about those future amounts. So this could use some discounting to present value to estimate the amount involved. Let me mention here that in some cases, there could be a single valuation technique which will be appropriate, whereas in others, you could have to combine multiple valuation techniques to arrive at your fair value. So take note, you could use either market approach alone, cost approach alone, or income approach alone, or in some cases, you have to combine a number of these. IFRS 13 has a number of disclosure requirements that will need to be fulfilled or complied with by an entity. But in summary, IFRS 13 requires an entity to disclose information that will help users of the financial statements assess both for the assets and liabilities that are measured at fair value on a recurring or non-recurring basis in the financial statements after recognition, the valuation techniques and inputs used to develop those measurements. So let the users of the financial information or financial statements know which valuation techniques you used and which inputs went into determining your fair value. And then also for fair value measurements using significant unobservable inputs, i.e. level 3 inputs, you need to also let your users know the effect of the measurement on profit or loss or other comprehensive income for the period. So these are the two main disclosure requirements. There are several other disclosure requirements provided for by the standard, but at the minimum, you need to let your users know the level of observable inputs you used and the level of unobservable inputs you used and the effect the unobservable inputs will have on your profit or loss and other comprehensive income, and then which valuation techniques you applied and the input you use in arriving at your fair value measurement. So this has been a summary of IFRS 13 fair value measurement. If you love this video, do not forget to smash that like button and don't forget to share this video within your entire network. I will catch you in the next IFRS summary video.